happy
Yeah.
that they are deploying capital to buy back their own shares.
We are, yes, we are very happy that they are. We think it's a very good thing. It needs to be done in a responsible manner, and they're doing it in a very responsible manner. So they accelerated their buybacks last year when their stock price came down. And that's a very important aspect of buybacks. You want to buy when prices are low. And as a long-term shareholder, right, they're buying back at a rate of they'll buy back about 5% of their outstanding shares over the course of a year. And so without doing anything, we become 5% more of an owner in their business. But yeah, they bought back about $14 to $15 billion over the last couple of quarters, with their newest announcement of $70 billion of buybacks in the coming year being authorized. We think that pace will continue. And as long as they continue to do it when the price is down, like it is right now, we think it's the right thing to do for long-term shareholders.
Hello and welcome to Invest Avenue, the channel dedicated to providing you with the latest insights and analysis on the stock market. In this video, we will be taking a closer look at Alphabet, the parent company of Google, and analyzing its stock performance. Alphabet is one of the largest and most influential companies in the world, and its stock has been on an impressive upward trend in recent years. As investors, it's important to stay up to date with the latest developments in the company and understand how they may impact its stock price. Throughout this playlist, we will be diving deep into the analysis of Alphabet's financials, management, competition, and industry trends. By the end of this series, you will have a comprehensive understanding of Alphabet's stock performance and be better equipped to make informed investment decisions. So, if you're ready to take your investing knowledge to the next level, make sure to subscribe to Invest Avenue and join us on this exciting journey. Evaluate the investment potential of Alphabet stocks, taking into account their recent 30% decline from their all-time high. Conduct a stock analysis to determine if the current market conditions present a favorable opportunity for investment. Business model: through its digital platforms, Google holds a dominant position in search and advertising, which allows them to generate revenue by offering targeted advertising. In addition, they expand their business by offering cloud computing services and investing in research and development to maintain their competitive edge. By exploring new opportunities such as autonomous driving and healthcare, Google continues to diversify its portfolio. Demonstrates a track record of effectively increasing both revenue and free cash flow. The company appears to have a healthy short-term liquidity position as its total current assets exceed its total current liabilities by more than twofold, indicating a surplus of liquid assets that can be utilized to meet its short-term obligations without any liquidity concerns. A nearly threefold difference between the total assets and total liabilities of the company suggests that it enjoys a robust financial standing and is financially secure. The company's significant total cash and short-term investments in comparison to its total debt indicate its ability to repay its entire debt immediately, if necessary. This financial strength, coupled with a surplus of liquid assets, suggests the company has a very strong and secure balance sheet. A fortress balance sheet typically comprises three main components. Maintaining adequate liquidity at all times, which means having sufficient cash reserves. Avoiding over-leveraging the company with excessive debt. Being well prepared to weather unforeseen shocks and maintain flexibility to seize opportunities that may arise. Valuation: the current price-to-earnings ratio is among the lowest observed in the past decade. To provide further perspective, even during the COVID-19 pandemic in 2020, the P/E ratio did not drop below 21x. The price-to-free cash flow ratio is presently close to its lowest levels in the past decade. To put this into context, even during the COVID-19 pandemic in 2020, the P/FCF ratio did not fall below 23x. There is a projected growth of plus 17% in free cash flow for 2023 and an estimated growth of 19% for 2024. Revenue forecast. Earnings per share forecast. Conclusion: based on its current financial standing, Alphabet appears to have a low risk of bankruptcy, as well as a P/E and price-to-free cash flow ratio is presently close to its lowest levels in the past decade. To put this into context, even during the COVID-19 pandemic in 2020, the price-to-free cash flow ratio did not fall below 23x. ratio near its 10-year valuation lows. The company also has a positive growth forecast and a strong balance sheet. Therefore, there is a high likelihood that Alphabet will achieve its projected growth.
Well, right now the cloud business is fabulous. They did about 26%, 28% year over year versus the other quarter, and that's on the back of 44% growth last year for the same quarter. So they're really knocking it out of the park with the cloud, and we expect that to continue going forward. Search obviously is their big behemoth, right? About $40 billion of the revenue comes from search. 40 billion of, let's say, the roughly $70 billion that they reported last quarter. So the fact that that's still growing in a somewhat softening economy was a definite positive for us as well. Alphabet bought YouTube in about 2006 for roughly $1.7 billion. They did over $7 billion of revenue last quarter. We think they're going to continue to grow quite rapidly as time goes on. The year-over-year comparisons are a little bit difficult right now because when everybody was staying at home and constantly looking at their phones and doing things on their phones, the pandemic really kind of pulled forward a lot of the numbers related to the likes of YouTube. So it slowed a little bit last quarter, and also they're starting to emphasize a little bit of these YouTube shorts to compete against TikTok and that sort of thing. But we think that over time, Alphabet's going to continue to approach this the right way, and we very much see YouTube is a valuable asset. I think it's about 25% of all internet searches these days actually are run through YouTube. Yeah, so Google has a huge moat, right? And so the notion that their 97 or 98% search share could get chipped into 0.08% a month over month when ChatGPT was introduced, it has a lot of people fearful. And Google's price fell off something like $80 billion in value when ChatGPT was first launched. And Satya Nadella, CEO of Microsoft, basically has told Google, let's dance. We really think that Google is the adult in the room on this. They've been very conservative with how they want to approach their artificial intelligence. For the last few years, they've had the ability to roll out their own artificial intelligence, and they've decided not to in the way that Microsoft, or let's say OpenAI and ChatGPT is. There's a lot of indications at this point in time that there's hallucinations, for instance, that happen with artificial intelligence if you ask it for more than a few questions in a row. And so there's a lot of call for that to be pulled back and slowed down. So at the end of the day, we think that Alphabet has a long-term great position in this space, and they will do very well over the long haul. They're just choosing to be more conservative, where others right now are choosing to go ahead and introduce artificial intelligence, and it's a big talking point. It's really fun to talk about right now, but we definitely think they're going to be a leader in this space, and it's going to be here to stay, for sure.
In my view, Alphabet presents a favorable risk-reward ratio and is a viable long-term investment option that has the potential for growth acceleration due to its optionality. Once market sentiment improves, it is likely that investors will begin to assign higher PE and price to free cash flow multiples to the company's stock, which would further enhance its growth potential.